I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. We skip if it collides with a tax filing deadline. Listen online, as you are doing right now, or later it's going to go up on YouTube, and just check our website for that. This month's topic is Subpart F income. Our favorite. Having gone through a series of sessions about who is a filer, who's required to file or not, we're going to now launch into the consequences of having to file Form 5471, namely, you got income that you didn't want. Subpart F income is, how everybody blames the baby boomers these days. Well, Subpart F income is part of the baby boom generation, 1962. That's when Congress infected us with it. And we're going to talk about how Subpart F income blows a giant torpedo hole in the hull of the SS Subchapter C ship of life. Here's the sessions that we're doing. So we're up to number 5. Subpart F income, as you can see, next month is the spawn of Satan type of income. And then we'll move on from there. And just a quick note before we start. Rachel's going to throw a link in the channel. In order to give us enough time for questions and answers afterwards, we're going to spin up a separate Zoom room from 1 to 1:30. So everything you put in the chat field will be thrown in there, and I'll answer questions and more besides. It just gives us enough time to deal with the questions and answers afterwards. And just for reasons of logistics, and we don't want Robert sitting around forever doing nothing, that's why we log out of the CalCPA stream and spin up a separate Zoom stream. Anyway, that's where we are. Table of contents as usual. And let's set ourselves on fire and let's talk about Subpart F income. All right, first, Subpart F. I don't think people talk about this much, but what's this Subpart F thing that people talk about? And the answer is it's a tiny little backwater in a back bay of the great ocean of federal law. So going from the top, when Congress passes laws, they go into the United States Code, and it's broken into 50 or 60 different titles. Title 26 is where all the tax fund happens. And it's mostly the same as the Internal Revenue Code. Sometimes there are some tax laws that are passed by Congress and are not embodied in Title 26. But I think I've seen that once or twice in my career. Mostly it's just a curiosity in my experience. Anyway, so Title 26 is where all the tax stuff happens for our purposes. And then Subtitle A is where all the income tax stuff happens. And then gift tax and estate tax and all the other fun stuff is not other subtitles. Subtitle A is broken down to a bunch of chapters. And Chapter 1 is where income tax, or as I think it's kind of humorous, normal taxes and surtaxes. But it's the income tax part. And then Chapter 1 is broken down into subchapters. Subchapter A, blah, 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 blah. And subchapter N is where I live most of my days, is all the international stuff. Subchapters are broken into parts, Part 1, Part 2, Part 3. Part 3 is income from sources outside the United States, because we're talking about, remember, income earned by foreign corporations outside the United States, a little bit in, but mostly out. You'll see the little bit in as we go through. And then every part is broken down to subparts, and Subpart F is what was inflicted upon us in 1962. And this is where this controlled foreign corporation stuff happened. And we had, well, you'll see how it works. All of a sudden, Subchapter C and C corporations don't mean what you think they mean. So now that you know what Subpart F means, the adjective, now let's say the noun, income. What does Subpart F income mean? And Subpart F income means you're simply looking at the gross income of a controlled foreign corporation. And I'm going to assume that you know what that is by now. And you look at it in the general journal and you tag it different characters, so dividend, interest income, sales of inventory, blah 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 blah. And after you've tagged all of the gross income items, you are going to look at section 952 and see if they fit into one of those five different categories there. And if they do, then it's subpart F income. And eventually that subpart F income will flow through and hit the gross income of your US shareholder taxpayer. So that's subpart F and subpart F income. Big, 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 big picture. Here is This is what the torpedo that puts the hole in the hull of the subchapter C. So you'd think that a foreign corporation would be treated just like a domestic corporation. The shareholder is not taxed on what happens inside the corporation until it receives a distribution. So you see the red stuff. A shareholder includes in gross income a pro rata share determined according to rules of the foreign corporation's subpart F income of the year. So that right there is the inclusion. And next month, when we talk about global intangible low taxed income and under section 951 cap A, you will see the other torpedo that the Internal Revenue Code fires at the hull of a foreign corporation and makes it a flow through entity instead of a classic C corporation. So there are some other related concepts or income types here. 951A, I forgot to edit that. So sorry that, sorry, brain fart when preparing these. Section 956. This is an anti-deferral thing that says if a controlled foreign corporation invests untaxed earnings and profits in U.S. assets, then we're going to treat that as if it's a distribution and include it in the gross income of the taxpayer. And go back to section 951A1, you see down at the bottom, it says, hey, in addition to subpart F income, A, also include the section 956 income in the shareholder's gross income for the year. So this 956 thing is not subpart F income, but it behaves exactly the same way. Section 956 used to be important back in the day before section 951 cap A became in existence, because it was entirely possible for a foreign corporation to have untaxed earnings and profits. In fact, this is why 2017 happened, because Google and Apple and all of those had hundreds of billions of untaxed earnings and profits locked in foreign corporations. And Congress said, give me some of that. Section 965, that's the one-time transition tax. That's not subpart F income. But if you read section 965A, it says, compute all of this stuff. And then when you've computed this, I think they call it deferred foreign income under section 965, include it in your subpart F income. So it's not subpart F income because it's not defined in section 952, but it's taxed just like it. And of course, next month, our big friend, section 951 cap A. Just as a 40,000 foot skim overview, the relationship between subpart F income and global intangible low taxed income. Think of global intangible low taxed income as sucking up the remainder of a controlled foreign corporation's income after you subtract subpart F income. So you see, we start at line 1, all the gross income of this controlled foreign corporation. And then we have some exclusions, A through E. And I've highlighted B, which is subpart F income. So you subtract that and you end up with a net number on line 4, which is the gross income that you're going to use to play that insane Sudoku game that's global intangible low taxed income, and eventually come out with a gross income number that's going to go onto the income tax return. And Subpart F income is not the only exclusion for global intangible low taxed income, but it's the one that we're talking about today. So it's a relationship. So if you arbitrarily think you have $1 of gross income in a CFC, it's either going to be global intangible low tax income or it's going to be one of those five exceptions. And then it's going to be dealt with accordingly, according to whatever rules apply to those exceptions. Now, having said that, our overlords in the Supreme Court may make all of this irrelevant. There's a pending case in the US Supreme Court right now called Moore versus United States. So some ordinary Americans put a trivial amount of money into an Indian corporation, and the Indian corporation did some, I think it was in the business of developing different strains of rice or something like that. Anyway, they own 13% of the stock of this corporation. And over the years, if I remember right, it ended up there's about $143,000 of E&P. Remember, this is before Section 965 came in. So Section 965 comes in and says, hey, guess what? All of that untaxed earnings and profits in that CFC are now going to be taxable to you, pay your tax. And the tax liability for them was about $14,000. And so they said, well, this ain't fair. And they sued in the Ninth Circuit and the district court and failed. And they went up to the appeals court and failed. And they went up to the Supreme Court. And Supreme Court said, yeah, we'll talk to you about that. And so it's pending right now. The idea here is that it goes right to the heart of what is income. And from 1920, this case, Eisner v. Macomber, the Supreme Court has said income is only income taxable under the Internal Revenue Code when it is realized. And so you think about if you have you're shareholder of a C corporation and there's untaxed earnings and profits in there. When are you taxed? Well, when they pay you a dividend. So you think about the taxpayers in Moore, they put some money into a little Indian corporation. Or you think about me that I own 100 shares of Microsoft, and Microsoft has some earnings and profits that haven't been distributed. Do I get taxed on the Microsoft earnings and profits? Answer is no, not until I get a dividend. So if the Supreme Court has the nerve to do what's consistent with Eisner v. Macomber in their concept of realized, Section 965 in the transition tax will be unconstitutional, and all of us will be scrambling to figure out how we can get refunds for our clients. More importantly, that now destroys the legal underpinning for Subpart F income, for global intangible low taxed income, for the exit tax, all of these things where income has not been realized. Like no event has happened where there is, as the Supreme Court calls it, there is an accession to wealth, accession with an A. Nothing has happened. It's like, my house has gone up in value. Are they going to tax me on that? No, they don't, not until I sell the house. So be very interesting to see. I don't think that, well, I was going to use some bad words, but I don't think they have the nerve to do what's correct. I think the challenge is correct by these taxpayers, but I don't think the Supreme Court justices have the nerve to be honest. So there you go. The other interesting thing about this, you say, how in the world does someone who has a $14,000 tax liability afford the legal fees to fight through the district court and the Ninth Circuit Court of Appeals? The appeals, Ninth Circuit, I mean, district court, and that's the trial, and then the appeals in the Ninth Circuit, and now the Supreme Court. I know firsthand how much it costs to take a case all the way from the district court up to the Supreme Court for argument. They don't have that kind of money. So I'm really curious about who's funding this litigation. I guarantee you it's going to be somebody like Google. So behind the scenes is just like, what was that one where they put Anyway, Peter Thiel secretly funded the Hulk Hogan litigation against that website that and eventually put them under. I think the same thing's happening here. Anyway, interesting. And if the Supreme Court does the right thing, everything gets reversed back to 1962. Good luck with us. All right. Why does Subpart F income exist? Answer is because we are the hackers of the world. If you think that you think of it like this, that the Internal Revenue Service and Congress is Microsoft writing Windows. We are the hackers trying to find exploits to break into Windows and make it do our bidding and do bad things. So, first thing that people do with offshore corporations, it's C Corp theory works. You put $1 million into that, you invest. If C Corp principles work, you have a foreign corporation making foreign income. That income is not taxable by the United States until it's distributed to the US shareholder. So you make $1,000 of dividends in year one. You keep reinvesting. You have compounding of your investments tax free. 20 years from now, you pay yourself a dividend. So you've got tax free compounding and you've played the time value of money when you've pulled out the dividend 20 years from now. Government doesn't like that. They don't want you to play the time value of money. They want you to have your income taxed now. So the countermeasure, and we'll see this in a little bit, is this type of income. You categorize the CFC's income as foreign personal holding company income, and that type of income, the shareholder is treated as realizing that income in the year that the CFC earns it. Or you have operating companies and say, I don't want to pay all the profit on, I'm manufacturing something. So what they do is they set up a subsidiary or a brother sister corporation. Manufacturing domestic corporation wholesales off the product to the foreign corporation, pays U.S. income tax on the wholesale gross margin, net margin, net profit. You know what I mean. And now you have a wholesaler, foreign corporation, selling that widget to a foreign customer and earning the retailer's part of the margin on the product sale. That retail margin is in a foreign country, earned by a foreign corporation, out of bounds from the US tax system. Therefore, deferral. And that's the game that Apple, Google, and everybody played forever. So the countermeasures, and we'll see this in a bit, foreign base company sales income to counteract the example I gave, foreign base company services income, where you're playing the same game except with services instead of things. I can't find words today. And then Section 956, which is technically not Subpart F income, but the idea was that you'd be playing this game, you create this giant pool of untaxed capital. You really need it in the United States as working capital for your business here. So you find some phony baloney way to bring it back. You lend it to yourself, or you do this or that. And Section 956 says, oh, BS, we're going to tax you as if you received it. So that's why it exists, because we're the black hats and we hack the system. And if you look at the Internal Revenue Code, you can just see it's a basic rule that's laid down, and then an endless series of patches put on by Congress to fight back when taxpayers figured out how to hack the system. Yay, taxpayers. All right. We know that Subpart F income is the thing that's going to flow through to the US shareholder. So what is it? There are 5 kinds. I have deliberately, except for the second one, not used the phraseology out of the code because I want to describe what it is. So the first one is, if you are playing games with captive insurance companies, that's Subpart F income. Classic example. You set up a captive insurance company in the Caymans, you pay your own captive insurance company a premium. Now you take a tax deduction on your personal income tax return or the corporate income tax return for insurance expense. The premium income offshore doesn't get taxed, does it? Okay, well, now it does. Second one, foreign-based company income. We'll talk a lot about that because that's where all the fun and games happens. Third one is participate in boycotts. So, or I think they phrase it international boycott income. Translate that into English. Congress decides that the Arab countries creating a boycott against people who are doing business in Israel is a bad thing. So they use the tax system as a tool of diplomacy. So that's what this is all about. If you participate in a boycott, basically of Israel, then you've got some subpart F income to deal with. The next one is if you are running around the world and paying bribes and kickbacks and whatnot, violating the Foreign Corrupt Practices Act, all those payments you make are going to be treated as subpart F income. And the final one is if you're going to go do business in North Korea, Iran, and places like that, we're going to give you some subpart F income. So that's what it's all about. Now, I want you to notice that 4 out of these 5 is pretty specific. You look at it and you can say, oh, I understand what's happening here. But you got to play this game of life with a little bit looking for the guy across the table. He's got some tells like in poker. And the tell in tax law is if you see this mushy blah, blah, blah language, you know this is where all the important stuff is happening. So we have this foreign based company income. Would an average human being know what the hell that is? Answer is no. And that's where I'm going to predict 95% of your work is going to be involved. Very few of us deal with captives a lot. Very few of us deal with boycotts and Foreign Corrupt Practices Act problems and this like that. I mean, I'm sure at the highest level, very, very large companies, this happens. I mean, I know a lot of bankers and I know a lot of bankers from other countries. And for instance, they'll fly into some of the West African countries, and the banks tell them in no uncertain terms if you get shaken down at the border, just abandon your laptop. So they deliberately take very little with them. But that's the level of Foreign Corrupt Practices Act kind of stuff. And, don't pay the $5 they're shaking you down for to save your laptop. All right. Redundant. I talked about these before. Next set of slides will have less redundancy, but these are the two that are closely related, but not subpart F income. Act the same way, though. All right. This is where everything culminates. Schedule I. This is subpart F income. And Schedule I is the shareholders pro rata share. And we're going to talk about specifically one of these. I'm going to use one of these items as an example so you can see how the system works generally and apply it to the others. So, subpart F income. So, here are the 5 types of subpart F income generally, and I've highlighted foreign based company income, which is the second of the 5 that are listed in Section 952. Foreign based company income has 3 subcomponents: personal holding company income, sales income, and services income. And then within foreign personal holding company income, because that's where I'm going to give you an example to show you how things go and how exceptions apply. Within foreign personal holding company income, there are 8 subcategories there. So within those, you'll see 1 through 7, and they track the definitions in Section 954C1, which is the definition of foreign personal holding company. And then you'll see 2.1.8, which is income from personal services contracts. Let me just give you a brief thing. I'm not going to talk about it, but I'll highlight what the sin that the government was trying to prevent. I'm a lawyer. I get a client who's going to pay me $1 million. So I don't want $1 million of my taxable income this year. So what I do is I go form a little corporation in the Bahamas, and the client pays $1 million to the Bahamas corporation, and the Bahamas corporation pays me $1,000 a month. I get $12,000. Yay. Okay, put the $12,000 on my Form 1040, pay the tax on it, no big deal. The $988,000 still stuck in the Bahamas corporation, tax deferred. As you might guess, the government doesn't like that. And so this income from personal services contracts thing is designed to prevent that from happening. And the key to this one is when the personal service contract specifies this is the person that is going to provide the services. So if the contract between my Bahamas corporation and the client that's going to pay me $1 million says we want Phil's services, this is going to run afoul of 2.1.8, and it's going to be subpart F income to me. So the full weight of the $1 million is going to be taxable to me in the year it's earned. So anyway, we're going to deal with 1 through 7, and specifically number 1 in the rest of the show. All right, let's do this. How it works. By now, I mean, I'm not looking at the chat window because I've got too much going on here, but by now there's probably some stuff in there. Have no fear. We will be taking that information out of the chat window, throwing it into the new Zoom chat, and I'll be going through the questions one of the other after the session. And again, encouragement to sign up and listen. It'll be like 30 minutes or so until I just absolutely need a cup of coffee and have to go for a walk, and then it'll be over. All right. Simple example. We have a U.S. citizen, 100% shareholder of a CFC. The CFC has one item of income, dividend income, let's say, is from Nestle. So it's from a foreign corporation. So no contact. The dividend income has no contact with the U.S. citizen, goes to the CFC. Without the existence of the Subpart F rules, the U.S. government would be unable to tax that dividend income from Nestle that's paid to the CFC. What do? Assume no taxes paid, no expenses. This is the classic incorporated wallet that up to 1962, the IRS just ranted about, and Congress and everybody else. It ain't fair. So how does it all work? And here's my welcome to worksheet A. So you're going to find this in pages 19, 20, and 21 of the instructions. And I have to say some very kind words about whoever works on the instructions for Form 5471. They are God tier. Really good. And you can notice how they've improved year on and year on and year on. Like up till this year, I believe, like it was kind of hard to organize what category filer are you and what exception applies. But now they've got that very neatly summarized, how you figure out if you're a filer, what exceptions exist for that category, stuff like that. And specifically on worksheet A here, which is where you compute your pro rata share of a CFC's Subpart F income. If you want to understand Subpart F income and how it works and where do the exceptions come in and how do the exceptions work, you would be well served by printing this out, grabbing a sharp pencil, making up a few random numbers like I'm going to show you here that we do with dividend income, and work your way systematically line by line through this thing. You will understand Subpart F income. I guarantee you. It is awesome. It looks big because it's trying to attack all 5 categories of Subpart F income all at once. When you just focus on one category, and we're going to be dealing with foreign personal holding company income, it doesn't look so bad. So we'll be skipping a bunch of lines. All right, let's start at the top. The first thing is gross personal holding company income. So we say the only thing happened in the CFC is $1,000 of dividend income. And so this, I mean, look how good this worksheet is. It even gives you a clue about where to look in the code for what they're talking about here. And I wish that more forms or worksheets would give these cross-reference cues explicitly, because this is one of the great things. If you're confused about what's the law here, grab the relevant form, work it through. You can reverse engineer and figure out which code section is at play. And then once you've got that, you can look at the regs and you can figure out what's going on. But here they made it easy for us. We're going to work all our way through. The other ones don't matter for our purposes because we don't have enough time to talk about it. But we're going to come up with, at line 2, gross personal holding company income. $1,000. Remember, we're talking about Bahamian dollars because all of these are in the functional currency of the corporation, but a Bahamian dollar is pegged to the US dollar because I like simple. So, lines 3 through 12. This is an example of how the worksheet clues you in to this weird thing exists, an exception, and this is how it works. They don't give you the references, but we'll talk through it. And I'm talking about exceptions later in the session. So we start. Um, line 5 is a carryover from line 2, $1,000, and line 7 again is just a simple math. Line 6 and 7, the subpart F income, the worksheet tends to glomp together foreign-based company income and insurance company income together because those are the places where taxpayers did clever taxpayer tricks and tried to achieve deferral. The other three are we are exporting our morality, Foreign Corrupt Practices Act, or we are using the tax code as a tool of diplomacy. They don't trade with the enemies and don't participate in the boycott of Israel. So we come up with, again, we've got our total adjusted gross base company income. Well, how did we get there? And the answer is see lines 8 and 9. Line 8, and I'm going to give you more detail later, says if you've only got a little bit of your total gross income, that's the foreign based company income, basically passive dividends, income, interest, rents, royalties, then ignore it for all purposes and you don't have to sweat it. On the other hand, if 70% or more of the CFC's income is this foreign personal holding company income, then you're going to have 100% of the gross income included in that way. So it's sort of a floor in the ceiling to get rid of stuff. And as we'll see later, I'll mention it. These are ways that this will affect your global intangible low taxable income calculation. And you may want to force yourself one way or the other in order to optimize the total tax load on the shareholder between Section 951 little a in parentheses, subpart F income, and Section 951 cap A income, global intangible low taxed income. All right. So there you go. Here's another place where the worksheet gives you a clue on how subpart F income works internally. It tells you that subpart F income, the inclusion on the taxpayer's income tax return, is the corporation's net profit. It's not a gross amount, because in line 13 we're subtracting expenses and doing some other fun stuff that don't really matter for my simple example. But in our case, we have none of those because by assumption we're doing expenses are zero and taxes are zero. So we end up with adjusted net foreign personal holding company income of $1,000. So we started with gross. We went to adjusted gross, which is the application of the de minimis rule and the full inclusion rule. And then we subtracted expenses. And now we've got at line 13H, the number that really matters. So this is the number that you'll see flows all the way through to the individual's income tax return. Now we're going to go to the adjusted income, and this is when we're glomping together base company income and net insurance income. And you see down at the bottom 2021, 22, the bad stuff. We're glomping it all together, and we're getting a single number, all 5 of these categories that were listed in section 952. And that single number is subpart F income before application of weird and special rules, because of course there are always weird and special rules. So we went in this worksheet from doing calculations category by category to a combined number here on line 23. Now, but line 24, 25, 26, we're going to end up with our separate number for foreign personal holding company income. Remember, this is just one of the pieces of foreign based company income, and foreign based company income is just one of the pieces of Subpart F income. The line 24 highlights an exception for effectively connected income. So imagine a CFC and it's sitting offshore and it's earning its $1,000 of Nestle dividends, but it's also actively doing business in the United States. So it has net income from doing business in the United States, effectively connected with a trade or business. Well, that effectively connected income is going to be subject to tax on a Form 1120-F that the CFC has to file. So we don't want to impose tax on that $1,000 twice. One at the CFC level, normal corporate income tax as applied on an 1120-F, and once to the shareholder because it flows through as Subpart F income straight from the CFC up to the shareholder level. So we back the ECI out of this income item that we've got. Because remember, so far, we started with gross income and we've just been working our way down. So that's what we're going to do there. So in the long run, the government doesn't care where a dollar of profit in a CFC is taxed as long as it's taxed somewhere. In this case, it's going to be an 1120-F on line 24. And then on line 25 is another methodology for preventing double counting or double inclusion of income. Exclusion under section 959B. So what does that mean? Let me give you it's important as you have a dividend paid from a foreign subsidiary CFC to a parent subsidiary CFC. And let me give you a little example. So let's first look at this and pretend that section 959B didn't apply. It just didn't exist. What you'd have is you have your $1,000 of dividend income, Nestle dividends received by foreign subsidiary, and we know that this creates foreign personal holding company income, and we know that foreign personal holding company income is foreign base company income, and we know that foreign base company income is Subpart F income, and we know that Subpart F income is included in the gross income of the U.S. shareholder. Hence the little swoopy red arrow to the right. That $1,000 of Subpart F income goes upstream and hits the U.S. Citizens Form 1040, and you'll see in a while where it shows up. But let's say, okay, after receiving that $1,000 of Nestle dividend at the foreign subsidiary level, foreign subsidiary pays that 1,000 cash upstream to the foreign parent. Well, if you look at sort of standard accounting principles and standard tax accounting principles and subchapter C and earnings and profits and all that fun, you have foreign subsidiary is paying a dividend out of earnings and profits to foreign parent. So foreign parent has dividend income, classically defined. Well, what happens? Well, okay, now foreign dividend received by foreign parent is foreign parent has $1,000 of personal holding company income because it had a dividend from foreign subsidiary. And so foreign parent's personal holding company income of 1,000 means foreign parent has 1,000 of foreign base company income, which means that foreign parent has 1,000 of Subpart F income, and 1,000 of Subpart F income goes from parent to the U.S. citizen. So now U.S. citizen has $2,000 of gross income because foreign subsidiary received $1,000 of interest of dividend income from Nestle. That's done. So so section 959B says that if the conditions are right, then you exclude the dividend upstream from foreign subsidiary to foreign parent from foreign parent's gross income. Now, if you exclude the $1,000 of dividends from foreign parents' gross income, then foreign parents' earnings and profits stay put, right? Because what increases earnings and profits? Earnings. And because there's no gross income. It's something else, but it's not going to add to earnings and profits. And therefore, foreign parent does not have foreign personal holding company income. Therefore, foreign parent does not have foreign base company income. And therefore, foreign parent does not have Subpart F income. And therefore, U.S. citizen does not receive $1,000 of Subpart F income from foreign parent. So, end result is all is good with the world. 1,000 in at the bottom, 1,000 taxable at the top. All is wonderful. And the way it works is Section 959B says if you have earnings and profits at the foreign subsidiary level, and those earnings and profits have been taxed under Subpart F, in this case by passing the earnings and profits upstream to U.S. citizen, then the dividend paid out of those previously taxed earnings and profits will not be included in the gross income of the foreign parent. So that's the picture. I'm going to have to speed it up because I thought this was simple, but it's complicateder than I expected. So we take these two things, and again, the worksheet A is your friend, has prevented you from stepping on your own feet, and we've calculated the foreign personal holding company income at the level of the CFC is still $1,000. Now, important distinction. There's a limitation. Subpart F income is includable only up to the earnings and profits of the CFC. Well, for the foreign subsidiary in our example, or the even simpler one, there's a single tier structure. $1,000 of dividend income increases current E&P by 1,000. We have no expenses, so we don't decrease E&P. So we have $1,000 on line 37A. And, through the simple total this and smaller of this or that, we still have $1,000 is included and it's not limited by the earnings and profits of the current year earnings and profits. So in other words, simple rule always, no Subpart F income out of accumulated earnings and profits. Finally, we come to the third page of the worksheet A, and this is where we're bringing all the totals forward. And line 39 is the application of this rule where the limitation of the pass-through earnings and profits is going to be limited by current earnings and profits. And that's what the reference is to regulation section 1.952-1E. And what happens is if you have a limitation like that, you're going to take the limitation amount, the excess, and you're going to adjust all of the categories of Subpart F income pro rata. So that's all that's happening on line 39. Since we're not doing anything about, we don't have that limitation, we don't have to worry about it. We're going to drop the full 1,000 of Subpart F income, foreign personal holding company income flavored, to be precise, on line 40. So big red line says we're stopping here with the corporate level stuff, and everything happening below this line is going to be shareholder level. And I'm clever, so I changed the color of the ink to blue, pixel ink. So now we have the pro rata share, and we're going to go with the rest of it. And I didn't bother to snip out the irrelevant stuff, but you can see line 49 is foreign base company sales income, and line 52 is the foreign base company services income. So you can see this is an example of how the spreadsheet encompasses all the different types of Subpart F income. And we do the calculation, and you're going to come down eventually to the line 61, important number, and which is the pro rata share of Subpart F income. And then line 62, where they're breaking out the foreign personal holding company income specifically of that's a component of the Subpart F income because they want to break it out. For an individual shareholder, it doesn't matter. For corporation, it does because for an individual, all of the Subpart F income just flows to a single line item. You glomp it all together, you get a blob number. For Form 1120, they spray the different numbers all over Schedule C. So here's where it comes out. 1E on the Form 5471, $1,000. And then from Form 471 Schedule I to Form 1040 Schedule 1, you port that $1,000 over to the 951 open parentheses little a close parentheses inclusion, which again, just to remind you, includes the Subpart F category income that we're describing. It includes the Section 956 income, and it includes the transition tax, Section 965, rest in peace, that we hope we never have to see again. That's all going to be on N. And then next month's session is the inclusion coming from global intangible low taxed income on line O. So we total everything up. This is just the other income schedule on a Form 1040. And we come up with line 10, extra income, 1,000. And there it ends up in gross income of the taxpayer on line 8. So unlike other things in the code like PFIX, where you calculate a tax and you slot the calculated tax somewhere else, or like a Form 3520, I don't know. Anyway, other places. There are two ways that the government taxes you on these weird stuff that happens internationally. One of which is throw the income into your gross income and compute taxable income and tax the usual way. The other way is compute special tax offsite and port the tax to the bottom line of the Form 1040. So that's where it is. That's how the income flow happens for the simplest of all simple types of income, dividend income received by a CFC. Now, on the one hand, I'm saying, well, that's so simple and obvious. On the other hand, almost every CFC is going to have Subpart F income of some kind or another. You might be able to get away with the de minimis exception and eliminate it, but it's there because a CFC is going to take its excess cash and put it into something and get dividends or interest or something like that. All right, so that brings us to the end of the walkthrough of worksheet A. Highly recommended as a learning tool. I sent out an email earlier this week to all of you asking for help about how to help a friend of mine sort of level up from being competent to being in command of the topic. And a lot of you said, look at the instructions, look at the instructions. Totally agree. The other, and I'm telling you now, the other ones are weirder and they take more work, but the flow of the income goes through worksheet A in very similar fashion. All right. In the time we have left, I'm going to just talk about a few useful exceptions here, and I touched on them earlier. And then we're going to take a break and we'll come back at 1 o'clock for the Q&A time. So again, Rachel threw a link in there, so sign up and log in at 1 o'clock and off we'll go. There are 5 here I'm just going to touch over. De minimis exception, the full inclusion exception, which I like to joke and call it de maximus sometimes. High tax exception, look through, and same country. The de minimis exception. So the de minimis exception and the full inclusion is kind of like the joke, when mama's happy, everybody's happy. When mama's not happy, ain't nobody happy. So think of that when you're talking about the de minimis exception and the full inclusion exception. The rule is here, you look at the foreign companies, the CFC's foreign-based company income plus insurance income. So remember, foreign-based company income was the foreign personal holding company income, the foreign-based company sales income, the foreign-based company services income, plus insurance. You say, is it under $1 million? If yes, continue. Is it 5% or less of the CFC's gross income? If yes, then you just arbitrarily say the CFC's foreign-based company income is zero. So what's the advantage of that? Well, in the old days, pre-Section 951 Cap A and pre-global intangible low-taxed income, you went from this income is going to be included in the U.S. shareholders' gross income to this income is excluded entirely from U.S. income taxation until repatriated to the U.S. shareholder. So is a difference between deferral and instant taxation. Yay, we like deferral. So you had a strong incentive to keep the number down below 5%. Now, if you do this and you take the number down below 5%, all that's going to happen is you're going to make the pool of potential global intangible low taxed income that much higher. So you don't get the deferral opportunity that you used to. This is a mandatory thing. It's not an elective thing, it's mandatory. So if you hit the target here, you're excluded. So this, and it happens on worksheet A, line 8. Oops, clicked too hard. De minimis exception. So there you see, if we had $1,000 of gross income and we use the de minimis rule to make line B 0, you can see how line 4, gross income for global intangible low taxed income calculations on Schedule I-1 would be 1,000. So it would be fully included for Section 951 Cap A income purposes. The full inclusion. If 70% or more of the CFC's gross income is foreign-based company income plus insurance company income, then 100% of the CFC's gross income is foreign-based company income. So mama's happy, 70%. Everybody's happy, where 100% is foreign-based company income. So this is a situation where a CFC has mostly passive assets, has some operating income of some kind, but it's 30% or less. Well, 29.9999% or less. And again, this is a mandatory thing, not optional. And so here is your planning opportunity. Can you re-engineer the operating activity inside this CFC? So if you want to avoid global intangible low taxed income, can you push it to all be Subpart F income? And you can do that if you can somehow manage to create foreign-based company income equals 70% or more. And perhaps you can do that by changing the way the corporation does business so that you trigger deliberately foreign-based company sales income or foreign-based company services income. We'll talk, I don't know when we'll talk about that, but it's important to talk about planning and playing Subpart F income against global intangible low taxed income somehow. Is there anything games to play there? A little bit. That happens on line 9 of worksheet A. There's the de maximis. So if you have $1,000 of gross income and you use the de maximis rule on line 2B to create $1,000 of Subpart F income, then line 4 is going to be 0, right? Which is great. Now you don't have to screw around with that idiotic Sudoku game that is Section 951 Cap A. But I do not judge. Next one, high tax exception. If your foreign-based company income plus insurance income, you're seeing a pattern here, is taxed in a foreign country at 90% or more of the US corporate rate, which you see the math there is 18.9%, then you can make an election to say, I elect to make this foreign-based company income excluded under the high tax exception. The code says shall, and shall is traditionally interpreted as mandatory. But the regulations say, no, this is an election. The taxpayer can toggle it on or off. So you have an election whether to toggle it on or off and to make this income, which is subject to tax in the foreign country at a high enough rate, either tax not Subpart F because you're just subtracting it, or Subpart F, and it's going to flow through to the U.S. shareholder. And this might make a difference for flow through of foreign tax credits. The look-through exception. Look-through exception and the next one we come to, same country exception, are kind of similar but kind of different. So, and depending, one might work for you, the other one might not, or vice versa, or they might both. And so you could, depending on what you want to do, maybe you can use these to your advantage. So, the look through rule. You've got a payment of one of these passive types of income, foreign personal holding company income types, from a CFC to a related CFC. And the related CFC does not receive the income received as foreign personal holding company to itself. So this is good, right? Because now you don't have a problem from the recipient point of view of having foreign personal holding company income. And therefore, you're not going to have double taxation. The key to the look through rule is this second bullet. So the payment of this passive income, a dividend, interest, rent, must come out of E&P of the payor that's not Subpart F income and is not effectively connected with the conduct of a U.S. trade or business. Translation, it has to be coming out of E&P that is from active business activity that classically now falls under the global intangible low tax income regime. So, assuming you can get that, you can use the look through rule to prevent the taxation. So, what this means is under the pre Section 951 in Section 2017 days, a CFC could earn some profit offshore from an active business, and it could redeploy that capital to a related CFC without accidentally triggering some income and therefore tax liability for the U.S. shareholder at the top level. So it gave a group of related companies the ability to move capital around on a tax efficient basis. So that's why it exists. And you subtract it off the worksheet on line 1A when you're defining gross income. So here's an example, the look through rule, where the $1,000 of dividends comes upstream from the foreign parent to the from the subsidiary to the parent, and personal holding company is zero. Same country exception. This is another way where income can be moved between related companies without tax costs to the U.S. shareholder. So you have, again, you focus on the payor, and here the phrase is, are substantially all the assets used in an active business in that country? So you look at that, and then you say, if you can answer that yes, then you look at the two CFCs, and are they related? And if yes, then the personal holding company income received by the payee is not calculated as part of Subpart F income. So you've moved income from the active business to, let's say, a holding company without artificially creating Subpart F income. So here I've got an example where the active business is Foreign Corp 2, and it's paying some interest to Foreign Corp 1, which could be parent company. No, it's not a parent in my example, but it's a related company. And therefore, we don't have a Subpart F income problem with Foreign Corp 1. So again, you can redeploy capital efficiently without accidentally creating tax liability. There we are. That was fast. It is complicated. Subpart F is less important than it used to be prior to Section 951 Cap A, because in the old days it was between deferral and not deferral. Now it's not deferral under one rule versus not deferral under another rule. What's better? Pick your poison. So that's the kind of game that you play now. But even though the game, you still have to play the game, even though the stakes are lower. So, and again, I encourage you, use worksheet A, paper, pencil.